welcome to the Leader's Edge podcast. I'm Sandy Laycox, Editor-in-Chief of Leader's Edge. In this edition, I sat down with Ramnath Balasubramanian, a senior partner at McKinsey focused on insurance and private equity topics, including strategy, digital and analytics transformations, and distribution. Also joining us is Matthew Scally, a partner at McKinsey serving private equity clients on developing funds, due diligence, and supporting portfolio companies after acquisition. His work also includes a focus on employee benefits. We discussed a range of M&A topics, including the runway left in core retail brokerage, alternative insurance acquisition targets, and accelerating the complexity of risk. I hope you enjoy it. Matthew, Ramnath, thanks so much for joining me. We are here to discuss private equity investors and their role in insurance, mergers and acquisitions from a variety of angles. So we'll just go ahead and dive right in. The first topic we're going to talk about is distribution in general across the insurance ecosystem. We'll break it down in a few different categories, starting with the core retail brokerage sector. So my first question for you guys is, obviously this sector has been hot for a while in terms of M&A. What has made it successful for both private equity investors as well as the brokerages they acquire? And then give us a little look to what's left in that runway.
Yeah, the what's left in the runway question is probably number one on all our diligence support that we do with our private equity clients and sponsors who are investing in the space. I guess to take your question from the top, Sandy, what has made it successful? The insurance brokerage industry on a standalone basis is exceptionally valuable. It's a core part of the ecosystem. It has elements that both private equity and other investors really value, and that is recurring revenue, long-term relationships, and clearly part of an ecosystem that generates a lot of dollars. If you look at the total amount of premium that's placed in the corporate market, whether it's in the jumbo section or small market, it's massive. And being able to be a part of that, creates a successful foundation. Now, it's not all about throwing dollars into the space and just allowing it to grow. Private equity is as much about investing as it is about business building, right? And given how fragmented the industry is, it's created a lot of opportunities to sophisticate the sales force management, to improve and sophisticate the placement of premiums, which creates value for the end customer, the insured, as well as for the brokerages themselves. And I think all of this has in some way led to a really nice marriage between private equity and the insurance brokerage space. And of course, the other major driver that comes from it being a fragmented market is the fact that M&A and roll-up is extremely accretive, again, to the companies that are being acquired, but also to the platform that's acquiring them. And there's some simple math that's involved, right? If a dollar of EBITDA is worth 8, 9, or 10 times in place number one, the smaller regionalized broker, and it's worth 15 times plus in a larger platform, smart people are going to come into the market and figure out that arbitrage.
What about that runway? How much do you think is left?
Ramnath, I'm happy to start here. Yeah, that's question number one on all our diligences, as well as the work we do with our corporate clients, our corporate brokers who are building, expanding their M&A plan. This is an industry that has seen roll up and accelerated M&A over the last 5, 10, 15 years. But interestingly enough, very consistently, there's more and more folks hanging their own shingle, which means over time, there are new, smaller mom and pop brokers that are coming up and growing their business. And the math behind this that we look at, when we talk about core EB, employee benefits or human capital brokers, plus PNC, there's something like 22,000 or so brokerages in the US based on our math. Now you have to net out some of the single personal lines brokers, those that are only doing Medicare Advantage, for example. But we think the math is about 22,000. And we use that same methodology going back to 2016, that number was somewhere around 23,000, right? And the math is, with all the accelerated M&A over the last 5 years, there's been a decrease in maybe about 3%, 3 to 4% of the total brokerages that are out there. So when we see and talk about runway, we're bullish on the ability of this to continue to occur and continue to happen. I think a major driver will be, is there still enough of that arbitrage, that multiple delta between the value of, call it a sub 5 million revenue brokerage shop versus the large platforms of the world.
I think a lot of the conversations we tend to have with private equity sponsors in this place, as well as brokerages as well, does tend to focus on M&A. And Matt talked about the runway which exists, and why M&A has been such a strong thesis for the better part of the last decade. And I think we do believe that it will continue to be an important part of the thesis going forward. That said, we do also believe that at least over the next 5 to 7 years, the sources of value creation will expand. In particular, we think that there are 3 additional sources of value creation which we are starting to see private equity sponsors as well as brokerages focus on. The first one really being what we call premium yield. How do you make sure that you're able to appropriately optimize, right, the commission dollars you actually collect for every dollar of premium, right? And what we've seen a lot of brokerages do is now starting to bring in analytics to actually help identify where there are leakages, where there are opportunities for actually optimizing this premium yield. So we do think that's a big source of value, particularly because it drops straight to the bottom line, actually has near-term impact as well. So not everyone does that well today. I mean, we've seen opportunities in the largest brokerages, but we also seen opportunities in the small brokerages. So that's one. 2 is organic growth is going to be a big differentiator. If you see the quarterly statements for a number of brokers, I think a lot of them are focused on their organic growth. I mean, over the last several quarters, organic growth has been quite robust in the industry, right? Mid-single digits. You are kind of seeing differentiation starting to happen there across the brokerages. I mean, there are some brokerages that are starting to click, high single digits, low double digits in terms of organic growth. And again, there are a number of opportunities in terms of how you think about a sales and go-to-market model. How do you really use analytics to better identify prospects to retain clients over time? So organic growth, we think, is going to be another source of differentiation. And then finally, we think there's going to be this theme around better leveraging digital and analytics across the value chain, right? Whether it's in terms of helping you drive the core performance, everything from, like I mentioned, premium yield to identifying prospects to retention to actually in cases where you're actually kind of managing claims on behalf of clients. How do you really kind of do that? And then there are all other opportunities in terms of leveraging analytics in terms of creating new revenue streams, right? Whether it's in terms of providing benchmarking solutions to clients, or whether it's in terms of providing advisory to clients and helping them with their loss optimization strategies, to all the way from actually kind of creating brand new businesses. So we do think that the arc going forward is going to focus a lot more expansively in terms of value creation levels, and the game will be won by those who are able to effectively deliver on it.
Thanks, Ramnath. That was really helpful, and actually leads me into a question that I'm going to jump around a little bit, but you talked a lot about the value of the data, and that's something that we wanted to get into a little bit in terms of this M&A conversation and the equity in the data. Is that something that acquiring data sets? Is that something that you think we'll be seeing more from PE in terms of trying to make acquisitions specifically around that point? And then I know there's a lot of regulation around that. So how does that come into play?
First of all, I think a lot of brokerages sit on a large treasure trove of data, right? It just sits in multiple different places inside the brokerage organization, right? Given a lot of the policy, systems which have kind of been fragmented over time, but the data they sit in, right? Because brokerages see a lot of flow in terms of core data, right? In case of the clients, they actually get to see a lot of the claims information as well, from geography, type of risk perspective, right? So they're in a unique position in this ecosystem where they're actually kind of seeing data both from the clients as well as on the carrier end, right? So I think that's a great starting position to be in, and very few of them have actually kind of tapped this data effectively because it's not been a priority for most people. What we're also now starting to see is augmenting the data which exists with brokerages with data which exists in the outside world. think about geospatial information about clients' activities, right? If you're a retailer, right? How do you know how the business is doing based on what the footfall traffic is in and out of the retailer, and how does that compare with the retailer who's actually next to you, right? One strip mall versus the other strip mall. And there are providers out there which are now starting to bring to bear, I would say, different types of non-traditional data sets, which brokerages and carriers are finding to be quite valuable in making decisions when it comes to helping identify prospects. If you're an MGA, for example, you can use it to actually do the first level of underwriting of risks as well. So we do think that there is significant value in terms of combining data which exists with brokers with external data. Obviously, maintaining guardrails around PII and confidentiality, which obviously is something which needs to be established, and it's a thing which the foundations have to be built. But we do think there is massive value. I think we are at an inflection point right now in terms of how brokerages can actually leverage data to drive greater levels of performance.
Yeah, and the data that sits within brokerage houses, to Ramnath's point, is certainly underutilized or undermined. But private equity firms have consistently invested in and around the insurance ecosystem, and that includes service providers who have access to either proprietary data or algorithms to evaluate that data. And I think that's only going to continue. There is probably going to be an arms race that's going forward to the service providers as well as the brokerages, and certainly the carriers who are underwriting these risks, particularly on the commercial lines side, where there is a lot of competing dollars. And in order to best position yourself, I think utilizing your data to the utmost is going to be even more important over the next 3, 5, 7 years in our mind.
So for PE, private equity-backed brokerages that have been acquiring and acquiring a lot over the past few years to grow, do you think there will ever be a pullback on their M&A activity and more of a focus on, efficiencies, brand cohesion of all the different brands that come in from the PE investors?
There's a few elements that drive this. I think fundamentally, as long as there is going to be a difference in the value of that EBITDA, whether it sits on a small platform or a larger, you will have M&A as one of the core drivers and core parts of an investment thesis for any financial sponsor. Now, we have seen this movie play out over, again, 10, 15 years now, and there has been more sophistication once you reach to a certain size, right? Do I want to ensure that I'm centralizing a lot of my back office functions, right? To ensure I'm driving as much value as possible from that. Can I sophisticate the CRM process, the sales process? And another big driver of centralization post-scale, post-M&A roll-up is a succession planning. Right, the brokerage industry is older in terms of demographics than the national averages. Because it's such a relationship-driven business, the importance of succession planning coincides with a lot of the scale these businesses have acquired over time. And yes, I think that has driven the more focus towards centralization. But again, I don't see it as an either or, right? A pure graduation from an M&A roll-up shop to a centralized, sophisticated broker that is not doing M&A. It is a bit of a balance between the two, but I don't think you give up one for the other.
Yeah, and just to build on that, right? If the last decade was probably 90-10 in focus in terms of M&A versus some of the other value creation levers, we think the next decade will be more like 50-50, right? So M&A will still be important, will still be an important part of the overall thesis, but some of the other levels we described, right? Premium yield, organic growth optimization, digital analytics will become a lot more important as well, right? And I think, in fact, the differentiation in terms of those who do this well versus not, I think will be in part to how they're able to execute on the other value creation levels.
Yeah, and Zaidi, I think you brought up an excellent point too, as it relates to value chain compression. I think what you're getting at is, are retail brokers spending their time, and others, looking at wholesale, reinsurance, specialty opportunities? I think the answer is yes, right? That is another arrow in the quiver for financial sponsors as they think about diversifying their business as well as growing it. through M&A. And I think you're going to continue to see more of that. As we work with our clients, we talk consistently about what their value chain compression plan is. How do they want to own different elements of the distribution channel outside of just retail? And I think that's top of mind for many of our clients, and I think many folks within the industry.
So we're going to move away from the core retail brokerage and into some of these alternative distribution plays for PE. There's a wide range of them that you've mentioned in past conversations. So let's just start with the wholesale specialty reinsurance space.
We continue to see increasing and accelerating rates of the complexity of risks that are being placed in the market, both pre and we believe post-pandemic. So the more complexity, more specialty, the more important underwriting becomes, the more important additional, let's call it distribution channels, specialty and wholesale brokerages, and then the reinsurances for the carriers. So as long as you're seeing and continuing to feel the acceleration and the complexity of the risk being placed, whether it's on the personal lines or on the commercial side, I think you're going to see an interest from private equity sponsors following this trend and putting their dollars behind it. And then it ties back to what we discussed earlier, the value chain compression. Are you going to see more substantial roll-ups and combinations here? I think that remains yet to be seen.
And the complexity of the risk doesn't seem like it's changing anytime soon.
I would say the acceleration of the complexity of the risk,
right.
yes, it is going to continue to happen. I mean, you have how do you think about valuing, protecting data? And we typically, 5 years ago would discuss cyber risk. Sure, that's one piece. But what about the data as it's essentially insured in and of itself, as opposed to client risk, right? You talk about the value of NFTs that are happening now. Well, once you start placing a specific value on a data and it's compromised, what happens then? And how are you going to underwrite that as a carrier? And how much risk do you want to keep that on your books? How much do you want to offload to the reinsurers?
Yeah, the NFTs would be a whole nother conversation that potentially we could have another time. So another one that you had written about in a recent report as insurance marketing organizations, which I would love to hear your thoughts on. This was a new one for me in terms of a target for PE.
Yeah, I think if you look across the distribution channel, and you look at the large scale or long tail runway of those, call it 22,000 or so smaller regional or mom and pop-esque brokers, they are now more and more competing with producers who have access to better sales channel management because they have been acquired, have better access to data, right? Have better access to benchmarking, placement resources that exist. So how do they compete? And I think you see affinity networks where private equity has started to evaluate and put money towards. You see marketing agencies, as well as MGAs and GAs to a certain degree, all coming together. And a lot of the general support here is, how do we make you as competitive as possible as a small market broker to now compete against your rolled up colleagues or competitions that are sitting there? So again, whether it's an MGA, whether it's an affinity network, right, that is helping you with your own placement in Salesforce, whether it's a marketing agency that is, improving your own position in your community or getting you access to carriers you wouldn't have had access to. These are all important levers, and I think ones that will continue to grow because, as we talked about earlier, we fully expect the M&A runway to continue for the next many, many years.
Maybe just to kind of add on, I think on the independent marketing organization space, that space is probably, maybe 5 to 10 years behind where the retail brokerage, property and casualty EB space is for a few reasons. One is it's still highly fragmented. So, there are, over the last few years, you've seen kind of the emergence of what we would call consolidators, which are rolling up smaller platforms and, trying to bring, I would say, more organization, discipline, kind of, formal support to these to the small agents. And you've seen private equity actually kind of participate in that space, right? A fair number of IMOs are still privately held or family owned, right? They were started by the founder and they've grown over time organically, right? And so there's still a fair amount of, I would say, opportunity space out there for private equity to participate in this. I think there are some inherently different characteristics between what IMOs do in terms of the product set versus what the retail brokers do. I think by design, given IMOs focused more on life and annuity products, right? Effectively think of it as that you need to have replacement sales every year, right? You don't have the benefit of essentially having a large book of business and you just kind of grow that business over time and the business is sticky, right? The life and annuity business essentially kind of needs to be sold every year, right? So you need to kind of sell a new annuity every year. Could be to the same client, could be to a different client, right? If you sold a life policy in a particular year to your client, it's unlikely you'll sell a life policy again that particular year, right? And the way the compensation structures work in life insurance, right, it's heavily weighted towards new sales, right? And it tails off pretty substantially when it comes to renewal trading sales, right? So the onus for the agents or the advisors or part of IMO to actually kind of go and hunt every year is much higher than when it comes to retail brokerage and this, right? So it is much more, I would say, a spiky, deal-driven kind of structure, which is why I think it's taken a little bit of time for private equity owners to kind of get their heads around this business. It doesn't have the same kind of cash flow profile, certainty cash flow profile as what they see on the retail brokerage side. That said, I think the opportunity which exists is really it's probably much less advanced in terms of sophistication. There's a lot more you can do in terms of supporting these small agents, mom and pop agents, with marketing, with lead generation, so that they can actually go and to a client in helping with work with the carrier partners to define customized solutions and products, right? So there's actually a lot of runway when it comes to IMOs. And the last point I'll make is that some of the larger IMOs are also trying to diversify their revenue streams. So because they have franchise relationships with clients, they have a book of business with clients. They're trying to see if they can supplement that by adding RIA type of services and capabilities. You're starting to see situations where IMOs are actually consolidating RIAs and bringing those suites of capabilities to their agents.
So under the guise of competition, right? We've talked about, we have all of these different factors that are competing in different segments of the brokerage market. So for example, we have the employee benefits segment, different competition happening there. We've got the PC segment, different competition happening there. We've got different competition happening in the small versus the middle versus the larger segments of clients, right? So break down for us some of the more interesting or more relevant to our audience competitors that you guys are seeing right now. Just give us a little taste of some of those more interesting ones that you all find.
Well, competitors can be a loaded word. I will say that. I think you're right, though. There's blurring lines and overlapping Venn diagrams that we're seeing here. I think one piece on the EB side where we've seen consistent growth is the PEO market, which I'm sure many of your viewership is well aware of. The pre-pandemic, we would estimate roughly 4 million lives were under a PEO employment model, which means their workers' comp, which is on the PNC side, technically a PNC line, is being placed through those entities and then it's aggregated. A bit of a misconception is that all those lives are pulled into a centralized or master health plan. I think that's not the case. I think the majority of PEOs offer that. Something like really 30 to 40, 30 to 50% of lives uptake that. But that is certainly premium commissions and or fees that are being pulled out of the small end of the broker market and aggregated up. And it's not revenue that's leaving the distribution channel, but it is being consolidated because these PEO providers themselves have their preferred 1, 2, or 3 brokers, typically more scaled, not as localized. It varies very differently if you are a large scale PEO with 500,000 plus lives, worksite employee lives, WSEs, versus some of the micro fragmented PEOs that maybe have 10 or 15,000 lives. But at the end of the day, you're seeing that as a tool that's consolidating this. And it's been a very effective way for businesses to improve their premium costs, right? Because they're getting larger scale per employee workers' comp charges to them. It's also a way for them to outsource simultaneously some of their traditional HRIS, whether it's payroll or benefits administration. So it's a model that we think is going to continue to grow off that 4 million base. I think we've estimated it could grow in the 10 or 15% per annum range, which means 5 or 7 years from now, you could have 8 million plus lives in that space. That starts to be meaningful. And to dimensionalize it, we think there is roughly, call it 35 million lives that are addressable by the PEO market. So even that 8 million number doesn't really kind of reach that ceiling or threshold. That's an interesting place. And how you compete with a PEO model is going to be very important, more and more so for some of the regional mom and pop brokers. And that again ties back into, well, what additional services are you going to be able to provide? Are you partnering or hiring or acquiring insurtechs in and around that space? I know there's many others, Ramnath, if you want to pick one or two as well to go into.
Yeah, again, maybe the only thing I'd add over here is that, again, wouldn't call it kind of necessarily competition, but in the employee benefit space, for example, this convergence between health and wealth is increasingly becoming relevant, right? And so as brokerages look to kind of, provide the full suite of capabilities and services to their clients, how do they, add on to what they're doing on the health side with capabilities on the wealth side? So you're seeing, cases where they're collaborating with RIAs, or in other cases where they're actually acquiring RIAs, right, to bring those capabilities to their clients. So I think you're seeing this trend in terms of, I have a client, right? How do I kind of, maximize the full suite of value and services that you can provide to clients? And I think you're going to see increasingly them extending out in terms of areas which, may not have been kind of, natural sweet spots for them for decades.
And one of the things that I forgot to mention when I asked this question was it's really competition for the end client, right? It's who's getting closer to that end client in the work that they're already doing. With the PEOs, that's a great example.
Yeah. Another example, Sandy, would be benefit administration, right? Which is, again, if you look at kind of the workplace being kind of where, is the primary kind of channel for accessing clients and customers, then, who really owns that end client relationships, right? Today, it's a very dynamic ecosystem, right? You have, benefit consultants, obviously, who historically had the relationships with employers. You had the benefit administration platforms, right? Which, started off, with 10 years ago were more kind of for transaction processing, but now are kind of providing the full front end in terms of engagement capabilities. You have the advice, guidance and advice firms, still quite niche, but again, they're playing a valuable role over here. So you're starting to see a lot more convergence happening there as well, right? You're seeing brokerages who, acquired benefit administration platforms, right? Because, things are moving away from just employer to employer sales to actually, voluntary and more employee-driven purchases. So, having that point of access is important. You're seeing, carriers actually also trying to acquire some of these benefit administration platforms. Again, all in the spirit of, how do you get deeper and deeper access to the end client? Because the game is shifting, right, from just being B2B to being B2B2C, between the employee benefits.
That's a really important point, I think, that Ramnath brings up. And to be a little provocative here, I think the brokerage industry as a whole has done a phenomenal job of adapting, continuing to add value, maintaining their relationship, and really being a trusted partner for the insureds. But one area where they may have slipped a little bit is ceding some of the administration and also, by the way, the enrollment capabilities to other players in the ecosystem. And we think that's going to be becoming more and more important for a few reasons. The first is just the general move to the consumerization of healthcare, right? You continue to see the growth in self-insured lives, as well as a model where consumers, not just millennials, but employees and consumers as a whole, are taking more of a control of their healthcare spend, their management, whether it's through health savings accounts or just an active role in it. And that is the transition that Ramnath is talking to. It's not just a B2B component where I own the relationship with the CFO, with the benefit manager, with whomever. It's also a relationship with the employee that matters. And as healthcare becomes more consumerized, as we potentially have more remote work environments, the enrollment and then the guidance and advice that the employee, the consumer, needs and ingests is going to be becoming more and more important. And I think brokerages really have to think through what is their plan for enrollment period, what is the plan for our employers' employees, and how are we going to stay very, very relevant in that space.
So one final question as we wrap it up, still looking at the global economy. I'd love your guys' thoughts on just different financial recovery scenarios over the next couple of years. How do you see this playing out in terms of the PE space?
So Sandy, I'd say that it's been remarkable how resilient the economy has been in 2020, despite everything which has gone up, right? And I think it's it's a function of interventions and what governments as well as central banks have done across the world. I think we remain cautiously optimistic about 2021 and the path forward beyond that. And you're starting to see, that in the indicators around us as well, when it comes to consumer sentiment, manufacturing pickup, the last 2 or 3 quarters in terms of economic growth. And you're starting to see that optimism clearly reflected in the deal environment, right? If you're seeing, the deal environment since late summer, early fall of last year, it's probably been the hottest deal environment we could ever experience, as much as we can go back. And so I think we expect the deal activity to be fairly robust in the coming quarters, and for most of 2021 and into 2022. There is huge kind of pool of capital out there looking for investment opportunities. This also means that the competition for these deals is going up significantly. We've seen that as well in terms of the multiples that some of these assets being traded at. You've seen obviously special purpose acquisition vehicles as a big source of alternative kind of exit strategies for a number of these players, right? And that's going to continue. I think it only emphasizes the point we made at the beginning of this discussion, is that the arc of value creation has to be more expansive, right? It cannot be just reliant on 1 or 2 things which will do well, which is largely M&A or consolidation driven. It has to be a lot more holistic. And frankly, I think to be able to justify these premium valuations, you have to demonstrate that you can execute on those value creation levels better than anyone else.
Yeah, to end on a somewhat positive note, I fundamentally believe private equity plays a core and important role in our economy. Everything from providing pensions, endowments, other capital sources with access to middle market private growth companies, to sophisticating and growing those companies, right? They're in the business of building businesses, as I said a few times. And I think that role isn't going to change in the near future. And I'm bullish on their ability to execute on it, even with some of the multiples growing.
So it sounds like we can potentially end here on an optimistic note. More action in the commercial insurance industry to come. It's going to get interesting. We'll get into data, we'll get into AI, and hopefully be able to continue this conversation as we go forward.
Yeah, as you said, who would have thought insurance can be cool, but it is.
I love it. It's great. Matthew, Ramnath, thank you so much for this time. It's been fascinating talking with you, and I hope we get to do it again soon.
Thank you.
Wonderful connecting with you, Sandy.
Pleasure.
Thank you.
That was Matthew Scally and Ramnath Balasubramanian of McKinsey. Thanks for listening, and don't forget to tune into the rest of our podcasts at leadersedge.com.